All right, guys. Thank you for joining me this afternoon. As always, my name is Tony Zhang. I'm the chief strategist here at Options Play, and today we're going to be talking about how to trade earnings like a pro. First of all, I want to thank everyone for joining us this afternoon. I see a lot of familiar names here, and for those of you that are new to Options Play or have never seen one of our webinars before, welcome. Today we're going to be teaching you things that you need to know before you trade earnings using options. I want to point out that trading earnings it's risky. It's not easy to do, so it's really important for us to make sure that you understand that what to look out for when you're trading earnings, and making sure you have the right tools in order to analyze the trades properly before you place a trade. So before I get started, I'm just going to put a poll out there real quick. If you can, just please enter or answer the poll, just so I have an idea as far as who is in the room here. Okay, looks like most of you, or almost 90% of you, have traded options before. About 10% of you are new or just starting out. For those of you that are experienced, great. For those of you that are brand new, try to follow along. This webinar is recorded, so we will send you the recording after we're done here. I will also include the slides in that email that I send out with the recording. So if you're brand new to options trading and you're starting out, just keep in mind that trading earnings is a more advanced strategy. So make sure you understand what you're doing before you place this trade. And I recommend that if you're new to trading earnings, to do it with just one or two contracts at first, as you play around with these types of strategies before you start trading larger contracts. Okay, so it looks like we've got about 91% of you guys have traded options, so only 9% of you are new. That's okay. So in today's webinar, what we're going to do is we're going to spend about 10 minutes on teaching you some of the concepts that you need to look out for when you're trading earnings. I'm going to use the slides to do that. And then the rest of the time, what I'm going to do is I'm going to be using Options Play, the actual tool that you guys have access to show you some real examples that you can use and how to use our tool to set up and analyze a trade so that you can place the trades correctly for trading earnings. So just a quick overview as to what we'll capture, what we're going to go over here today. Number one, we'll look at a recap of what happened in the earnings seasons in Q1. That helps us set up for what we're looking for in the earnings seasons coming up, the Q2 earnings seasons. We'll cover kind of what are some of the best and worst sectors that we scanned for Q2, so that you have an idea as far as which sectors you might want to focus on when you're looking at earnings going into earnings season. We'll talk a little bit about option Greeks, because it is really important for you to understand the few Greeks that are relevant, because option prices change a lot around earnings. So it's really important to understand what those things are and how they impact the price of an option, because that is going to be what you need in order to effectively trade options. Trading earnings using options. And then, like I said, what we really want to do is go through some live examples with some P&L simulations so that you guys can see how these trades are impacted based on earnings. So this webinar, I think, is fairly timely. We just came off of some pretty volatile times over the last few weeks. We've had everything from trade wars to talks about inflation that have generated some huge volatility in the markets. And I actually think this, as we go into earnings seasons in Q2, this helps shift some of that focus back towards corporate earnings, which is really what drives stock prices. So we want to make sure that we understand what we're looking at going into this earnings season. And I think that hopefully this might bring some recovery back to the market as we focus on earnings season coming up. So let's just do, I just have one more poll here. So for those of you, since most of you have traded options before, I just wanted to get a feel for, how many of you guys have traded earnings before, whether you traded them using stocks or options, or if you've never traded earnings before. So it looks like we've got about a 60-40 split. About 60% of you have traded earnings before using either stocks or options, and about 40% of you would be your first time. So great. So we have a very nice split here in the room. That's exactly kind of what I was hoping for. So for those of you that have traded options before using or traded earnings using stocks or options, hopefully you learned something new or learn how to use our tool to help you better find the right trades. And for those of you that are brand new, I hope you guys learned something and you can actually utilize this in your trading for your portfolio. So let's just go ahead and jump into it. What I really want to cover is kind of what does Q2 earnings, what are we expecting for Q2 earnings? So let's start with recap of what happened last season or last quarter. So in Q1, we had above average beat for both earnings per share and sales. So this is a fairly reoccurring theme over in 2017 or the second half of 2017 was that we started to see companies beat on both sales and earnings. This was something that wasn't in place, in 2015, 2016. A lot of those beats in earnings was really because companies were cutting costs, not because they were actually growing their sales. And that really started to shift in 2017. And that's really why we've seen such a strong equity market throughout 2017 was because companies were growing on the top line, not just on the bottom line. So we had some of the strongest sales beats last quarter in the last 5 years. And the one thing that we did see was that overcrowded stocks got hit the most. So basically, stocks that beat on earnings had a relatively small outperformance, and stocks that missed on earnings had a very large underperformance. That was the one key theme going into 2017, I think we should, or going into Q1 that I think we should also be cognizant of Q2 is because valuations are pretty heavy at this point, even though the volatility over the last few weeks have really brought that down a little bit. However, we're not seeing companies that beat have a huge outperformance, but we do see companies that are missing have a huge underperformance. So definitely something that we want to keep an eye out for as we go into earnings season this quarter. So talking about what we're expecting for Q2, so far forecasts are showing really strong sales growth going into Q2. The early reports and the macro reports that we look at, or such as ISM, are showing strong sales growth and beats going into Q2. So that is something that to look out for, and it's a net positive overall for the equity markets. Again, I hope that this helps shift some of that focus away from trade wars and some of the rhetoric that we're seeing back to kind of what really drives stock prices, and that's earnings. The big theme for Q2 really is the tax reform. This is really where we're starting to see how the companies have adjusted or what they're doing with the tax reform that was passed in late 2017, whether they're going to build or they're going to buy back shares, whether they're going to invest it or return it back to shareholders through dividends. This is really the reoccurring theme as to how companies will use this tax break that they've gotten to boost their bottom line. So that's really the theme to look out for in Q2. Aside from, we have a few other things like oil prices are a little higher, so we see some energy stocks. Energy stocks are one of the sectors that got highest positive revisions going into this quarter. And also FX, the weaker dollar has certainly helped some of the multinational companies a little bit. So all of these things are generally speaking net positive for the earnings season going into Q2. So now that we have an idea as far as what our expectations are from a big picture perspective, let's take a look at kind of what sectors are interesting for Q2. So some of the best, or so where we're seeing the highest upward revisions in both sales and EPS, this is basically what the analysts are predicting or going into earnings season, or what their expectations are, whether they're increasing their expectations or decreasing their expectations. We're seeing materials, industrials, and energy have the highest upward revisions. These are where analysts have the biggest expectations of stocks to beat or have an increase in their expectations of what they're going to deliver for both sales and earnings per share. And then utilities, real estate, and telecommunications are the three weakest sectors from this perspective. These are the ones that are showing the most downward revisions. So those are some key themes to keep an eye out for going into Q2 earnings season this quarter. So now that we have a picture on kind of what our expectations are for the earnings season, let's take a look at how do we trade them. And before we look at what strategies to trade an earnings season, or even looking at individual stocks, it's really important for us to understand how do option pricing change around earnings, because there's a lot of change in option pricing around earnings. So it's really important that you understand the three main things that impact an option price around earnings. So those are three things: are Delta, Vega, and Theta. And I'll go over each one of these. And keep in mind that you just need to know these from a theoretical perspective. You don't need to know how to calculate it, because our platform does all of these calculations for you. I just want to make sure that you guys understand what these things mean, okay? So don't worry about the numbers. Don't worry about having to calculate them. Our platform will do that piece for you. So talking about Delta, this is the change in this price of the option with respect to the change in the price of the stock. So during earnings, this is where we see the largest stock movements of the year for most stocks, is usually when an earnings comes out and they either beat or miss, and you usually get a large move up or a large move down. So Delta just tells you how much the option price will change based on the change in the stock price. So an example of 50 Delta option means that for every dollar the stock moves up, you should expect that option to move by 50 cents, okay? Again, you don't have to memorize or know how to calculate this. Just understand that Delta tells you how much the stock, or how much the option price will move with respect to the stock price. Vega, this is the second most important piece when we're trading earnings, is the change of the price of the option with respect to the change of volatility. So what happens is volatility tends to be very elevated before earnings, because there's a lot of uncertainty as to where we think the stock's going to be, or implied volatility rather. And then once that earnings event comes out, that volatility will come significantly lower, because we now know exactly what the earnings are. There's no more uncertainty anymore. So that volatility always comes down after earnings. So Vega tells you how much the price of the option changes with respect to the change in the implied volatility. So if you have an option with a Vega of 0.25, then you're expecting a 25-cent decrease in the price of the option for every 1% change in implied volatility. So again, right after earnings, we generally see implied volatility come lower, and that's really where we expect changes in the option prices right around earnings. Lastly, Theta. This is where the change of the price of the option with respect to time. So basically, as time goes by each day, the value of an option actually decreases in value, and that's what Theta tells you, is how much does it actually decrease by. So when you see a Theta of 0.10, that really means that this option is losing roughly 10 cents in value for every day that goes by. So these are the three things you need to look out for when you're trading earnings, because these are the three things that will, generally speaking, have the largest impact to the option price that you are trading, okay? Delta, based on the change in the price; Vega, based on the change in volatility; and Theta, based on the change in time. So let's talk about trading earnings. And this is really why trading earnings is difficult. This is why trading earnings is risky, because I call it one step forward, two steps back. Because what you get with an earnings is you get a large stock move when the stock beats or misses, right? So this is the one thing that's working in your favor. So if you're long a stock and it beats, then you get this large move in your favor immediately. Well, basically instantaneously based on that earnings call. So that's working in your favor. However, with that one thing working in your favor, you always at the same time have two things working against you. You have volatility crush. This is what I was talking about. The volatility, the implied volatility comes lower right after earnings. That's going to decrease the value of your option. So that's working against you. And also time decay is also always working against you, because time always marches forward. There's nothing you can do about that. So volatility and time decay are always working against you, and the large stock movement or delta is working in your favor. So when we talked about those three Greeks, delta, Vega, and Theta, delta is the one that's potentially working in your favor if you call it correctly, but at the same time, Vegas and Theta is working against you at all times going into earnings. So keep in mind, this is why trading earnings is difficult, because you always have only one thing working in your favor, but two things always working against you. So in order to make money trading options or trading earnings using options, number one, you have to not only get the right direction, meaning you have to pick a beat or a miss correctly, but you also have to get a large enough move from that beat or miss in order to make money. Because volatility and time are working against you, you have to make that up by a large move in your favor. So even if you call the right beat or miss, but the stock doesn't move very much, you may actually still lose money, even if the stock goes in your favor a little bit. So maybe the stock moves 1% in your favor on a beat. Sometimes that may not actually be enough to make money on the trade. So sometimes if you call the right direction and you get a large move, that's when you make money. But even if you call the right direction, but you get a small move, a lot of times you may actually still end up losing money on the trade. So that's why trading earnings is not easy. That's why it's risky. But there are some large potential gains if you do call it right and you get the right large enough move, okay? So obviously if you call the wrong direction and you get a large move, you're going to lose money. If you have the wrong direction, no matter what, basically you're going to lose money. So that's really why trading earnings is risky, and you only have 1 in 4 chance, if you will, out of these scenarios to make money. The other 3, you're likely going to lose money. Sometimes most of the option premium that you've paid, okay? So let's now talk about what strategies can you use when you expect a beat or a miss. So there's generally 4 strategies that you can trade. You can trade a long call or a long put. So a long call would be if you're bullish, so if you're expecting a beat on the earnings. You would trade a put if you're bearish or if you expect a miss on earnings. But based on trading long calls and puts, these strategies have unlimited profit potential. So if the stock goes really, really high on a bullish call or really, really low on a bearish call, you have unlimited profit potential. This is a strategy that you use when you expect a big move in one direction or another. So if you expect a stock to really blow up earnings or really miss earnings, you would want to generally trade just a call or a put. This strategy does put, generally speaking, a larger amount of money at risk. This is where you're risking probably the most amount of money when you're trading earnings, is when you're just outright buying a call or a put. But you trade this only when you expect a large move in your favor. The other strategy that you can use, this is not as popular, but it is a strategy that you can use, is a long call vertical or a long put vertical. And same thing here, a long call vertical would be a bullish trade, so if you expect the stock to beat and continue higher, or a put vertical if you expect the stock to miss and move lower, okay? And this strategy, unlike the call or a put, has limited profit potential. And you know what that limited profit potential is before you enter the trade. You'll know exactly what your risk is and what your profit potential is when you're trading a call or a put vertical. This is a strategy that you would use if you expect a modest or a slower move. So if you don't necessarily expect the stock to blow out earnings, but you do think that it might make a modest move and continue going in that direction over a period of time, the call or put vertical does minimize the risk, the volatility crush, and does also minimize the time decay factor. So that's why it is more useful if you're expecting a smaller move or the move to happen over a longer period of time. And the strategy does, generally speaking, put a smaller amount of money at risk. So if you're not 100% sure on a beat or a miss, but you still want to play this, sometimes put verticals or call verticals is a way to do it with slightly less risk. the thing that you want to generally keep an eye out for is you want to trade expirations that are generally 2 to 3 weeks after the actual earnings date. This is so that you give yourself a little bit of time after that earnings, because many times the stock may make a big move on the day of earnings, but it will actually have some continuation or follow through for about a week or two. So you want to give yourself some time to capture some of that if you're expecting that stock to potentially go in your favor after the earnings date. So you generally want to give yourself a 2 to 3 week buffer at the minimum when you're trading earnings. So with that, I just want to jump right into using options play. We're going to pick some stocks. We're going to take a look at some of these earnings plays and show you some real examples of how to use our tool to quickly find option strategies or option ideas. So I'm going to cover a few big names here. Again, I want to make sure you guys understand the stocks that I'm going to go over here today. These are not recommendations to trade. They're not recommendations based on where I think the stock will be beat or miss. These are simply purely examples for illustrative purposes. I don't have a magic 8-ball. However, I do want to say that if you're trying to pick companies that you think are going to beat, you generally want to use companies that have strong relative strength. So technical scores of 7, 8, 9, or 10, strong relative strength stocks tend to have higher probabilities of beating, and stocks with weak relative strength, the scores of 1, 2, or 3, generally speaking, have a higher probability of missing on earnings. So that's the only thing I want to make sure that you guys look out for when you're picking these stocks. Picking beats or misses is certainly never an easy proposition. So the technical score is one thing that you can look out for when you're looking at individual stocks. So I picked Microsoft here. It's just a big tech stock that most of you are familiar with. I'm going to use this as an example. For those of you that are brand new to options play, or if you've never seen one of our webinars before, just a quick overview. This platform is available to everyone. So you have trade ideas and watch lists here on the left. We have our security analysis panel here in the middle, and then we have trading and income here on the right. So these 3 panels represent the what, the why, and the how of stocks and options trading. So what means what trading ideas do I want to take a look at? You can use either our pre-built scans for trade ideas. We have bullish and bearish ideas every day that you can filter and sort by. We have a watch list functionality, which with pre-built watch list, we actually have all the sectors here for you so that you can get a feel for what's currently going on with each individual sector. You can sort it by that relative strength score so that you can quickly determine which sectors are strong, which sectors are weak. You can even drill down into individual sectors if you want to look at the stocks within an individual sector. The security analysis panel here in the middle is designed to help you give you snapshot data so you can quickly see what's going on with the stock. You have 1 month and 6 month trend indicators to give you a feel for short and long-term trends. We have a technical score. This is our relative strength indicator so that you can quantify how strong a stock is versus how weak a stock is compared to the overall market. And one of the most important things is if you're trading earnings is to know when that earnings date is. So that is right below your historical chart. For any stock that you type in, you'll see the earnings date here at the bottom. That's what you want to use to determine which expiration dates you want to choose. And then trading and income here on the right, this is where you actually find the strategies to trade. So we'll always default to 3 strategies: buying the stock, buying a call vertical if you're bullish. And if you're bearish, we'll always default to shorting the stock, buying a put, and buying a put vertical. And this is designed to give you instant strategies and a starting point without having to first bring up a chain, pick up an expiration date, then pick a strike price, then do some analytics. This provides instant ideas, instant strategies at your fingertips for any given view you have on the underlying stock. So let's start taking a look at a few different examples. And what I really want to focus the time on here today is using our P&L simulator, because that's really going to help you determine what you can expect from each option strategy that you're analyzing, and seeing what the expected return of each strategy is based on your given outlook on the stock. So let's take a look at Microsoft. It's trading at 92.38 right now. This reports earnings on April 26th, so about 21 days out. So we can take a look at the May 18th, which is roughly 3 weeks beyond the earnings date that we're looking at. So it's in that 2 to 3 week window that I'm talking about. And like I said, you can have two options. You can either buy a call if you're expecting a large move in that particular stock, or you can buy a call vertical if you think that it's going to be more of a modest move. So here it cost me $360 to buy a call, cost me $264 to buy a call vertical. So this is where it depends on what your views are on the stock. As you can see, buying a call has a little bit more risk. You're risking $360 versus $264 on the vertical. So let's say, and this is where we want to use the P&L simulator, because like I said, there's three things that impact your option price: the stock price, the date as to when you expect it the move to happen, meaning how much time goes by between now and the time you exit the trade, and lastly, volatility or Vega. So Microsoft's trading at 92.38 right now. Let's say we think it's going to go back up to this 52-week high, which is around 97. So if you think the stock's going to beat earnings and go up to 97, and let's say it does this the day after, a few days after earnings. The earnings is on the 26th. So let's say on the 27th, you expect the stock to move up to $97. And we know volatility will come down a little after earnings. So let's say it goes down to about 20%. Here, as you can see, you can very clearly see how these stocks will perform. So if you had bought this call, which cost you $360, you're making a 37% return if the stock moves to $97 the day after earnings and volatility comes down, which we know it does. So this is a very likely scenario of what may happen if, let's say, Microsoft beats earnings and it moves about $4 or $5 higher. As you can see here, if you bought the call, you make a 37% return. If you bought this call vertical, you make a 56% return. So interesting strategy to look at. So even though this strategy gives you less risk and it has that limited profit potential, that's really kind of where you're actually seeing a higher return, because it costs you significantly less to get into this trade by buying the call vertical versus buying the call. And this is really the power of options play, because if you're using an option chain to decide which strategy to trade, it's really difficult for you to compare buying a call to buying a call vertical with a specific outlook that you have on the stock. This allows you to put these two strategies side by side, put in the expectations you have in the stock, and see how each strategy performs, okay? So maybe someone else might say, no, I think this thing's really gonna blow it out of the water. I think it's gonna go to 100. Let's say you think it's going to go to 100. As you can see, if the stock moves to 100 on the day after earnings and the volatility comes down, these two strategies are actually roughly the same, about 102% return on the call, 113% return on the call vertical. So as you can see, this allows you to really play around with this and see how each strategy performs as the stock moves higher. So basically what this is saying is that for most scenarios, the day after earnings, if you're expecting a large move, really the vertical is going to give you the higher return, unless the stock really goes above 100. If the stock goes above 100, as you can see, that's where you're going to start getting higher returns here on the call versus that call vertical. Because that call vertical has limited upside potential, that's really where if the stock really takes off, you're not going to be able to participate on that. But for most modest moves here, as you can see, if the stock moves a little bit higher, or even if it moves all the way up to 100, you're going to get the higher return here on the call vertical. This allows you to confidently say, this is the strategy I want to trade versus that, okay? And you can even do, what happens if I'm wrong? What happens if the stock goes down to, let's say, 87 bucks after earnings or 85 bucks after earnings? As you can see, you pretty much have a total loss on the trade, 97% loss. But on the vertical, because it costs less to get into that trade, you're losing less money. So you're only risking $256 per contract versus $350 a contract. So a little over about 1% of that, a little over 30% more risk on trading the call versus the call vertical. So that's really why this strategy here on the right gives you the higher options play score, because if you're right, for most scenarios, you're actually going to make a higher return. And if you're wrong, you're actually risking less money. Okay, so this is an example with Microsoft where it seems like for most scenarios, you're better off trading this vertical versus the call. But usually when we're looking at these option strategies around earnings, it tends to be that the call will generally give you the higher return. But in this case, the call vertical actually gives you the higher return. So that's something that, you can't figure out by looking at a chain. And that's really why we advocate for those of you that are trading, whether you're trading earnings or even if you're not trading earnings, using this tool, using the P&L simulator to simulate where you think the stock's going to go and seeing which strategy gives you the higher return. Okay. And you can use it for all types of strategies. You don't have to use a call and the call vertical. These are just two strategies that we recommend for most of you that are newer to options trading, or if you're trading earnings, these are two strategies that you generally want to do. But you can trade all types of strategies. If you want to trade credit spreads, if you want to trade calendars and diagonals, you can do all of that. These are all types of strategies that you can do, and you can compare this side by side and see which strategy gives you the highest return. So, I just saw someone ask about calendars and diagonals. You can do that and put the two side by side and see which strategy gives you the highest return. There's no other platform that allows you to put these three strategies side by side and see which one's best suited for you. Okay, so let's just jump through some more examples. I really want to try to go through as many examples as possible. Caterpillar. What's interesting about this stock is this is one of those industrial stocks that really got beat up over the last few months. So, I mean, depending on what your views are on the industrial market, maybe you think that this thing is a bit oversold. It's going to come back. You can take a look at clicking on I'm bullish. Again, this is not a recommendation to buy Caterpillar, or we think that it's going to beat on earnings. I'm simply using this for illustrative purposes. So if, let's say, Caterpillar is at 148 right now, and you think that, hey, this thing there's a bit of a triple bottom here around 142. You think that this thing is going to start moving higher back up. As you can see, this stock reports earning on April 24th, so about 19 days out. So again, the May 18th expiration is a pretty good a time frame for this. So let's take a look. Buying a call costs you $800. Buying a call vertical costs you $714. So not as big of a difference as the Microsoft one, where we had about a 30% savings. Here, you're only getting about 10% savings by trading that call vertical. So let's see how this actually performs. So stock's trading at 145 right now. Let's say you think the stock's going to beat it, and you think it's going to go back up to this 161 level. So let's say we think it's going to go to 160. We think that it's going to do that a few days after earnings. So earnings is on the 24th. So let's say we think it's going to go up there by the 26th or 27th. And we know volatility comes down after earnings. So let's say we do that. And as you can see here, the picture is a little different than Microsoft, right? So buying the call costs you $800, gives you an 88% return if the stock goes to 160, gives you a 90% return if that based on the call vertical. So the two are almost identical here if on a stock move up to about 161. So a little over about a 10% move in the next, what is that, 23 days. And you can use this for all types of scenarios. So what happens if you think it's going to make only a modest move to 155? As you can see here, you have a 36 versus 45% return move. And this also allows you to get a feel for how much does the stock need to move before each one of these strategies is profitable. So as you can see, the stock needs to move to roughly 152 for this call to break even, and roughly around the same price for this call vertical to break even. So you can also kind of ask yourself, do I think the stock's going to go above 152 on earnings? If I do, then great. This is a strategy that you might want to trade. If you don't think it's going to go to 152, then this tells you definitively that you shouldn't buy a call or buy a call vertical, because you're actually not going to make money if the stock only goes to 151 or 152. So this is really where this tool allows you a lot of flexibility to test different scenarios and see what your expectations are in terms of potential reward, but also more importantly, how much would you lose if the stock, what happens if the stock stays exactly where it is and doesn't move? How much do you lose? You lose 38% on the call, you lose 32% on the call. There is substantially dollar risk on the call vertical, so you're risking 229 versus 308. This allows you to definitively know these things before you place a trade and not figure these things out after you're in the trade, okay? So extremely important to use these tools before you get into the trade. And again, if you're new to options, if you're new to trading earnings, use 1 or 2 contracts to first start out and test these types of strategies before you start adding more contracts to your trading strategy. Let's take a look at Tesla. I think this is an interesting one to take a look at. This is a stock that's certainly been beat up over the last few weeks on concerns about Model 3 production rates, also about the crash with the autopilot in California. So these are some of the things that have been weighing on this stock. As you can see, it's taken quite a beating. Depending on what your views are on this stock, there are a lot of bears, there are a lot of, on this particular stock. There are also a lot of very strong bulls and people that are almost like a cult-like following for this stock. So let's take a look at, whether you think the stock's going to beat or miss on earnings. So this stock's had a pretty big jump. As you can see, it went all the way up to 305 today. So let's say you think the stock's going to miss on earnings. Let's say you think that the Model 3 production numbers are a bit overinflated and they haven't been able to hit those targets, and you think they're going to continue to miss some of those targets, and you think that they're going to miss on earnings. So let's take a look at some bearish ideas. This stock reports earnings on May 2nd. So again, the May 18th is still about 2.5 weeks out from that. So it's still a good expiration to take a look at. As you can see, buying a put here cost me $2,600. Buying a put vertical cost me $1,900. So a fairly significant savings there of about 20%, a little over 20% on this. The stock's trading at a 305 right now. It's just at 250 a few days ago. So you might think that this stock's going to revisit that 250 level that a few days after earnings, which is the 2nd. So let's say on that Friday, 2 days after earnings, you expect that the volatility obviously will come down quite a bit. This is a very volatile stock. So as you can see here, again, if you expect the stock to move down to 250, buying the put will give you 123% return. Buying the put vertical will give you 176% return. So again, this put vertical gives you a higher return if you are correct on a bearish move on Tesla. A few days after earnings and volatility comes down, significantly higher return here on the put vertical versus the put. So this stock really needs to move significantly lower, where to the point where the put becomes the better trade. So the stock needs to move down to almost 220. Yeah, around the 220 level, that's really when the put starts to outperform. So this stock really needs to drop quite a bit in order for that to happen. It's got to drop about 20% or about 20%, a little over that, 25% to get to that level. So you would have to have a pretty extreme move on Tesla where the put beats that put vertical. And this tool, again, allows you to quantifiably know that for sure before you get into a trade. So you just have to ask yourself, how bearish am I on Tesla? Conversely, there's a lot of people out there that are kind of permanent bulls on Tesla. There are a lot of people that will always buy every single dip on this stock because they really love the product. They really think that these guys are onto something. So if, let's say, you're bullish on Tesla and you think it's going to go back up to this 345 level, which was just at about a month ago, let's do the same exercise. You can buy a call for $2,300, buy that call vertical for about $2,000. So again, not as big of savings on the call vertical versus the call. So let's say what happens if this goes back to 345 the day after earnings, which is on the Friday, and volatility comes down to, let's say, in the 30s. As you can see again here, the call vertical gives you the higher return. The call gives you a 70% return versus 86% return on the call vertical. So, and this is, again, allows you to play with this. As you can see, the stock needs to move up to about 360 before this call outperforms that call vertical. So you do really need quite an extreme move to the upside as well, about a 20% move to the upside before that call starts to outperform this call vertical. So this allows you to very quickly see how each strategy performs given the different scenarios that you have, and you can always select I'm bullish or I'm bearish based on whether you think the stock's going to beat or miss. I'm just going to cover maybe one more example here. Boeing, here's a stock. Here's a stock that's been hit pretty hard in the whole trade war rhetoric because Boeing sells a lot of planes to China, and this is one of the products that China wants to slap a tariff on the U.S. for. So this is certainly a stock that's taken a beating on that. If you think that we're going to come to some kind of agreement with China and maybe it's going to avoid some of these trade wars, this might be a bullish play for Boeing. Again, this is not a recommendation to trade this. This is simply just taking a look at what's currently going on in the market. Again, very strong stock, so I would expect probably more likely a beat versus a miss. So let's take a look. I'm bullish. It cost me $1,500 to buy a call, $1,300 to buy a call vertical. This stock reports earnings on April 25th, so about 20 days out. So again, the May 18th is a pretty good expiration to look at. It's about 3 weeks beyond the earnings date. So here, as you can see, the stock's trading at 336. It was trading at this 355, 360 level just about a month ago, so that's not a crazy target for a beat on earnings. So let's say we think it's going to go to 360 the day after earnings, which is April 25th. So let's say it happens on April 27th, a few days after earnings, and volatility comes down. As you can see, there's not a huge difference between the two strategies. 67% return on the call, 75% return on the call vertical. They're fairly similar. If you expect the stock to move to 360, I think the stock's really got to move significantly higher for this call to become profitable or more profitable than the call vertical. Here, as you can see, the stock needs to move to roughly $367 for that to happen, which is right around this 52-week high. Is really kind of where the stock needs to go to before this call starts to outperform this call vertical. So this really all comes down to looking at stocks that are, about 3 weeks out from earnings. If you pick some stocks that are closer to the current earnings date, I think you're probably going to find that the call may be a little better for trading this versus the call vertical. Let me see if I can find some examples here. Let's see. There's not a lot of earnings coming up, so let's look at Bed Bath & Beyond. This is reporting a little sooner. So this is a score of 4, so relatively weak stock. As you can see, it's got bearish trend, so maybe you might think that this thing's going to miss on earnings. So here I'm going to buy the put versus the put vertical. The stock's trading at 21 bucks right now, so let's say I think it's going to go back down to this $19 support level on earnings the day after earnings, which is the 11th of April. So let's say on the Friday, 2 days after, volatility comes down. So as you can see, still the put vertical here gives you the slightly higher return versus the put. So this really all comes down to how much money you're willing to risk and how much you expect the stock to move on earnings. That will help you determine which strategy here is right for you, whether you buy the outright call or put, or if you trade the vertical. So with that, what I want to thank everyone for joining me this afternoon. I hope that we were able to cover as many examples for you guys as possible and making sure that you understand the 3 most important things to look out for when you're trading earnings. And that's delta, which is where the stock moves. Theta, meaning how much time elapses between now and the expiration date. And lastly, volatility, understanding that the volatility will come down after earnings. So you must factor that into your calculation of what your expected return on the call is, or a call or put is. So making sure that you use the P&L simulator, use it for all different types of scenarios so you understand where the stock needs to go in order for you to be profitable, and that will help you determine whether or not this is a trade that you want to make. So right now what I'll do is I'll open this up for a Q&A. If you have any questions, please type them into the chat window. I think there was a few questions that came in while I was talking, so I'll answer those first. And again, if you have questions, please use the chat window to take a look, or the chat window to send any questions. So I got a couple of questions about talking about Tesla's earnings. I already did that, so hopefully that covered that. I had a question about trading diagonal spreads and calendars, and I hope that I helped you guys understand that. So you can always modify any of these strategies. Use the strategy selector. You can trade diagonals. You can trade calendars. All of that is here available to you so that you can take a look at trading calendars and diagonals and see how they perform during the trade. Straddles and strangles. I'm guessing the question is, can you trade a straddle? And that's a great question. You can, absolutely. So this is a strategy that you can trade if, let's say, you don't know where the stock's going to go. You think it's going to make a big move in one direction or another. The only thing I will add, let's go back to, let's say, Tesla real quick. The only thing I will say is that, you can absolutely trade a straddle, but you actually double the risk that you're doing. So what I mean by that, so if you had bought the put, right, and you thought the stock was going to go back down to 250, let's do this again. 250 was your target price. You thought it was gonna happen in a few days after earnings, which was March 2nd. So let's say on March 4th, and volatility comes down. So as you can see here, if you had bought the put correctly, you would make 123% return or 176% return on the vertical, but you only make a 24% return on the straddle. Okay, so you really have to get a really large move on the straddle before you make any real significant money. And for most cases, even if the stock moves, significantly down to, let's say, 270, which is 10% lower, you're still losing money on the straddle. So you absolutely can trade straddles and triangles, but understand that the stock needs to move significantly higher. So as you can see, the stock needs to move to 357. So basically close to that that high or it is that high from the last few months just to break even on the straddle. And the stock needs to move down to roughly let's see, 260. So about a 15% move to the downside before you break even on the straddle. So you really need a huge move for the straddle and triangle to be profitable. And that's really why it's not as, you really need to make sure that you understand the risks of that before you place a straddle or a triangle. Frank is asking, previously you have favored calls over puts. Please explain again. I'm not sure what you mean by that. I don't favor one over the other at all. You trade calls if you're bullish on the stock or if you expect a beat, and you would trade puts if you're bearish on the stock. So the strategies aren't favorable. It's just depending on where you think the stock's headed. Robert's asking, how do you change the expiration dates? Great question. You can click on modify for any of these strategies, and you can change the expiration dates either by selecting from the drop-down menu, or you can simply click on right arrow or left arrow on the expiration dates to change the expiration dates. Great question. William's asking, the effect of earnings on price is key. How do we assess the potential of earnings on price? I'm not sure what you mean by that question. I hope that that was a question from earlier. The P&L slider is really how you see how the change in the price of the option affects based on the change in the price of the stock. Another question is, are you telling us to use your score or the score on the right? 3 choices to help make a decision. I understand your statement is that we must make the choice. I'm not sure, again, what you mean by that. So again, when you're trading earnings, what you mostly want to focus on is this P&L simulator return, because that tells you what your expected return is on the actual trades that you're making. That's really the most important thing, because you're worried about profit or risk on any single trade. The options play score is a risk to reward metric to let you know which strategy gives you the best risk to reward. But when you're trading earnings, that kind of goes out the door a little, because probabilities are essentially go out the door when you're trading earnings. So that's why I'm saying when you're trading earnings, the P&L simulator is the tool you want to use when you're trading earnings. And that's really the only case when you want to focus solely on the P&L simulator, and the options play score, it doesn't matter as much. But as you can see, most of the strategies that I was showing you, the vertical was giving me the better return and the less risk when I'm wrong. So that's really why these strategies give you that higher options play score, and the straddle gives you such a low options play score, because really for most scenarios, you're actually losing money on the straddle. It would actually take very large moves, so very unrealistic movements for that strategy to be profitable, and that's why this strategy gives you the lowest options play score. Great question. Any other questions? Mitt's asking, is there an option to check the backdated earning results? So one of the things that you can actually do on our platform, and this is a really cool feature, and some of you may not know that this feature exists. So let's say you're new to this type of trading and you're not sure how to go about doing this, or you just want to try it out without risking any real money. So if, let's say you think Tesla is going to miss earnings, but you don't want to risk real money yet, you can save a trade. So you can click on this blue share button on any strategy, and you can share this trade, or you can save this trade here by clicking on this link button. And what that does is it just simply saves this trade in your profile. So it's like placing the trade without actually having to risk any real money. What you can do is you can find these trades in your profile. So it's under your shared trade sections. So you can click on that Tesla trade that you saved from earlier. So if you were doing this last month or last quarter, you can find all the trades that you've made. And what it does is it actually tracks the trade with the live P&L. So you can actually see how the option affects based on earnings. So as you can see here, the trade P&L here is 0 because the stock hasn't moved yet. But if you come back tomorrow, if you come back after earnings, you can actually see how the strategy has performed based on your trade. So you can make a call trade, you can make a put trade, and see how they perform. It's a really useful tool for those of you that are brand new and want to track a trade without placing any real trades. Again, you just click on that blue share button, and that will be able to allow you to share that trade or save that trade in your profile. Great question. I have another question here. Is the webinar recorded? Yes, this webinar is recorded, and I will send you guys the slides with the recording afterwards. So especially for those of you that are new to these types of strategies, I highly recommend you to come back, review the webinar, go over those 3 things that are important to look out for when you're trading earnings, and making sure that you use the P&L simulator, because that's going to be your tool that's going to help you determine which strategy to trade and whether or not you want to trade based on your outlook on the stock. Frank, I believe that was a completely separate topic. I don't want to get a little sidetrack on this. Why don't you send me an email specifically afterwards to info@optionsplay.com, and I'm happy to answer those questions regarding selling calls or puts. Again, I don't have a favor for whether I like to sell calls or puts. They're both very valid strategies. It really just depends on what your views are on the market and whether you own the stock or not, really, when you're selling calls or puts. If you own the stock, you would sell calls. If you don't own the stock, you would sell puts. William's asking, what do we mean by trading earnings? Okay, so maybe this wasn't clear, but the concept of trading earnings is to basically try to profit from that quick move that happens right after the stock announces their earnings. So that's usually the largest shock or largest volatility or largest move of the stock happens right on earnings. So right on the earnings release, the stock will either beat its earnings or miss its earnings, and that's when you see a large move, usually in one direction or another. And trying to profit on that large move is what we mean by trading earnings. And the key thing here is by using options, by buying calls, puts, or verticals, you're limiting your risk. So even if you're completely wrong on that trade and the stock misses when you thought it was going to beat or vice versa, your risk is limited to what you've paid for the put or the call. Conversely, if you had bought the stock or shorted the stock, your risk is substantially larger. So that's really why we advocate that if you want to trade earnings or take advantage of that large move in earnings, use options to do that, because it allows you to do it with a limited amount of risk. The earnings date is one of the most important things to look at, because that is when the company is going to make that announcement, and that is when the large move happens, is on that date. So exactly, the date is very important here. Myron, we can also, to your question about why we cannot delete old trades from the shared location, it's really because we actually track those based on who shares them. So if you share that on social media and someone actually clicks on that and signs up for Options Play, we can actually refer that back to you. So that's really why we don't delete these shared trades, especially so that we can give you credit for those of you that are sharing on social media and getting us customers through there. So that's really why we don't delete that. Any other questions? Before I let everyone go, we are hosting the Summit 360, the Wealth 365 Summit, which is an online traders expo type conference. So I hope that many of you guys can take a look. There are about 70 plus speakers that will be doing this. And the great thing is that it's online, so you don't have to travel to the conference. You can sign up through this link that I just put into the chat box. I highly recommend, for those of you that are interested in learning about trading strategies, all types of trading strategies, to sign up. There's lots of speakers doing this. I will be speaking myself on April 12th at 10 a.m. where I'm going to be talking about generating income using options. I'll be using options play on that talk, so please sign up and you'll be able to view not only our presentation but also plenty of other presentations that you might find useful. They are giving away about $100,000 in prizes during that, so I highly recommend to take a look, especially if you don't have the ability to travel to the traders expos or the money shows. This is kind of similar to that, but you can attend digitally. Another question is, can one add technical indicators like ADX, RSI, and save that? So currently you can certainly add all of these. You can click on the expand button on your chart and all the studies are available here. So you have ADX, you have all of these available to you so directional movement system is ADX. RSI is all available here. The only thing we currently don't have is the ability to save a template to your chart. That's something that we are looking at a new charting package for in order to do that. So currently you can add them, but we currently don't have the save feature. But again, that is something we're looking to add. Another question is, don't you think typically the stock move takes place normally one day before the actual date? No, the move happens after. So if it announces on the morning, the move will happen as on the open. If the announcement is after the close, the move will happen overnight, and you'll see that reflect in the following morning's opening. So you want to enter the trade before the announcement happens so that you can capture the move on the actual announcement. Michael, thank you. I really appreciate the kind words. I hope, again, everyone finds this tool useful, not only in helping you select stocks to trade, but more importantly, making sure that you understand your risks and potential rewards before you get into a trade. I can't stress that enough. You must make sure you understand your risks, what happens if the stock goes in your favor, what happens if the stock goes against you before you get into a trade, so that you're not surprised after you get into that trade. That's the worst part about trading, is finding out something after you get into the trade. Make sure make sure you plan your trade ahead of time, and the P&L simulator allows you to do that. So you have a good expectation of what's going to happen if the stock goes in your favor, what happens if the stock goes against you, so that you know and you can plan for this. So you know how much risk that you're taking and how much potential reward you have, so that you can decide whether it's worth your while. Any other last questions? If there are no more questions, thank you, Myron. If there are no more questions, like I said again, this webinar is recorded. I will send you guys a recording in about an hour or two. Once we process the recording, I will include the slides as well. And please, for those of you that are interested in attending that online summit, please click on that link and register in the chat window. It'll allow you to get access to a lot of interesting presentations. And it's over 5 days, so there's a lot of things. So even if you can't attend one day, there's probably going to be some topic that you'll be able to attend and view. So please, thank you everyone for taking the time out this afternoon. I hope you guys learned something here today. We'll be back next week. So this was more of a topic for more advanced traders. We'll be back next week to talk about a slightly less or a topic more so for the beginners. We'll be talking about trading your first options. So for those of you that you said you're new to options trading and you haven't traded before, I highly recommend to make sure you sign up for that. I'll include a link for that in the email that we send out with the recording. So thanks everyone. We're signing off now. I hope you guys had a great afternoon, and take care. We'll see you next week.